So today I want to share with you a concept called the reverse market crash, which is a concept I saw from Patrick Bet-David's video.
So what is a reverse market crash? That's when all of a sudden the market just balloons up. And you're like, wait a minute, what happened? And you're trying to hold it, and you see the rich get richer and the poor get poorer.
Okay, so the reverse market crash happens when all of a sudden assets like stocks, Bitcoin, and real estate all just explode in value. And I promise the playing cards will make sense in just a second. I'm not just showing off that I can do sick card tricks, even though I can. But this reverse market crash is supposed to leave the poorest people that are not invested behind, making the rich even richer, and some people believe it's one of the worst possible economic outcomes. Now, believe it or not, this reverse market crash is not a new idea. It's a new name that Patrick gives it, but it actually has a different name. The official economic terminology for all the nerds out there that best describes this is actually what's called a melt-up. A melt-up is a sudden persistent rise in the price of a security or market, often due to investor hurting. And not hurting like, ouch, that hurts, but hurting like crowding the asset all at once. And it's happened in the past during the dot-com bubble between 1999 and the year 2000, and more recently after the pandemic. So let me just show you using a magic trick analogy, and you'll be able to do this trick for all your friends with very little practice and blow them all away, and explain complex economic concepts all in one. So here's what you do. Take a deck of cards, you flick it open, and just like this, with the power of your mind. You don't actually have to make that face though. All I'm doing is I'm squeezing the side of the box, and it's squeezing the cards upward, which is kind of what happens to asset prices. There's applied buying pressure in a single location, which squeezes those asset prices up. But it's also important to understand that during a melt-up, it's not based on any kind of fundamental reality. It's more like a magic trick, a psychological effect that causes everyone to do all this all at once. And that's also why melt-ups oftentimes come right before a meltdown. So just for the sake of completing this routine, just like asset prices have been squeezed upwards, eventually they fall back down. So check this out. By tapping on the box, you'd think the cards would fall down, but instead they go up into the box and we're right back to where we started. How this happens is because of inertia. I'm just holding the box and tapping it, which makes the cards go back inside, and this happens automatically. The point I'm trying to make though is that because there's no fundamental reason why stock prices can suddenly explode in value and therefore then eventually go back down, sometimes this happens very quickly, and other times this can happen over a very long period of time. And how this happens and why this happens in economics is a lot more complicated than a simple magic trick. Now in Patrick's video, he explains what happens in different countries around the world that cause their stock markets to experience these reverse market crashes or melt-ups. And the question in Patrick's video is, will this happen to the US economy? Some people believe it can, some people believe it's already happening, and it's been happening for over a decade of loose monetary policy if you look at our stock market. And that's why some investors like to buy into gold and Bitcoin, because they believe exactly this idea.
You know, so interesting too, because it's not just the US. I was just reading today, globally, these countries, these advanced nations and all this fiat currency are gonna have to spend $2 trillion on the interest alone, and they won't stop spending, Jack. They just won't stop spending money, and it's coming back to haunt them, and it's coming back to maybe people realizing fiat currency is not the place to be, huh?
So now I wanna help explain how this all can theoretically happen, how it's happened in the past, and what I'm doing to protect myself, and I want to break down these complex ideas using my bad magic trick analogies, so let's get into it. Hi, my name is Andrei Jikh, hope you're doing well, come for the finance, and stay for the magic, my one magic trick tutorial to rule them all. So Patrick starts off his video by saying that no matter what the government tries to do to level the playing field and make everybody wealthy, somehow it always ends up going wrong. In the early 1980s, for example, a bigger portion of all the added wealth was owned by the middle class. But fast forward almost 50 years, and middle class and lower income wealth shrunk by almost 50%. And now the upper income owns almost 80% of all the wealth. How did that happen? So let me just show you some of these reverse stock market crashes so you could see what they look like, which Patrick argues contributed to the inequality of wealth, because some of these graphs are just insane. Here's Zimbabwe's stock market, for example, where it goes goes up over 500,000 points in a very short amount of time. Here's the same thing happening to Argentina's stock market, where it goes up almost vertically. Here's the same thing happening to Turkey's stock market, which grows at a stable rate until it goes almost vertical. And here's the same thing with Iran. And here's the same thing with Venezuela. And just for context, here's how the US stock market looks today. So that's just a couple of these melt-ups or reverse market crashes in action, where a lot of money was concentrated in a single asset, where it caused that asset to spike in a short amount of time. Now, each of those countries faced its own unique political and leadership and technological and monetary problems, which Patrick shows in his video. If you haven't seen it, go check it out. But a lot of those countries also had a lot of similarities or a combination of the following. Number one, the printing of a lot of money, aka quantitative easing. This happens when a country isn't being very productive, so to pay off its debts, the central bank decides to print a lot of its own currency, which causes a lot of problems. Number two, those countries experience extremely high inflation, meaning the price of their stuff goes up really, really fast. So much so that they have to print bigger and bigger denominations of their bills. Number three, negative real interest rates. Even though the charts here show that interest rates were insanely high, in some cases 200% for Zimbabwe, their real interest rate was actually negative in some cases. And all that means is interest rates minus inflation. So think about it like this. If a bank is offering to pay us 10% for keeping our money in a savings account, but inflation is say 15%, then the difference between the two is negative 5%. Meaning, even if we decided to keep our money in a savings account that's paying us money, we're still technically losing money thanks to all the inflation. And whenever we get a negative interest rate scenario, that's what increases the odds of these reverse market crashes or melt-ups happening. Because people figure, well, if I'm going to keep my money in a savings account or cash and it's losing value, I might as well invest it somewhere. And that's why that somewhere goes up in value really, really fast. But now the question is, can all of this actually happen to US markets? And in my opinion, the answer is no, but technically yes. Some people believe that it technically already happened during the pandemic when we lowered rates to zero and we printed a ton of money. And we all saw how the stock market got squeezed. We saw the housing market get squeezed. We saw Bitcoin get squeezed. And now it's all slowly returning back to the way it was. There was definitely a melt-up. And will this melt-up continue as a result of loose monetary policy in the future? Or will we continue to see a slow meltdown over the coming decade? No one knows for sure, obviously, but here's something super useful to understand. This is the psychology of the market, as Pat explains.
By the way, the other day, Jerome Powell says he's not raising the rates. You know what happened to the S&P 500? Boom, 5% within a week. So what if all of a sudden Powell in the next few months said, we're lowering the rates, we're lowering the rates. You could see S&P and Dow just go boom, 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 which is called a reverse market crash. Something the wealthy would want, not something you would want for low and middle America.
Okay, so if you're confused here, all he's saying is that Papa Jerome Powell, the guy in charge of the central banks, says even though he's open to raising interest rates, which is bad for the stock market somehow still went up. Why did that happen? Because the stock market's current price is not based on what's happening today, because the stock market lives in the future. It's always trying to predict something about the future, especially when it comes to interest rates. And right now, the stock market is telling us Papa Powell is probably lying. He's not going to raise interest rates. If anything, he'll start to lower them in the future, which is good for stocks because companies can borrow money for cheaper and they can use this money to buy back their own stocks and to use this money to fuel expansion and the growth of the economy. Now that's not true today, obviously, because interest rates are relatively high, but the market thinks it will be true in the future. How do I know this? Because we can take a peek at the psychology or the brain of the stock market by looking at something called the CME Fed Watch tool, which predicts interest rates in the future. And right now, it's predicting there's a 100% chance that rates will stay the same between 5.25 and 5.5% at the next meeting in December. Now, Patrick also says that if we loosen monetary policy, if we lower interest rates, then it would cause all these asset prices to go up, causing this reverse market crash or melt up to happen, leaving the poor to get poorer and the rich to get richer.
Every time we're printing money to assume and say these politicians, we're helping the low and middle income family. You give them money, guess what they don't know how to do? They don't know how to save. They're experts at spending. The government doesn't teach them how to save. They just give them the money and they know they're going to spend it. And then when they spend it, what do they buy? They buy a product. Somebody owes them. They owe this. They buy a camera. They buy a drink. It goes to the companies. So you give the money to the poor, knowing the money is really not being given to the poor. It's going to flow to the top, which is who? The rich. That's how the rich keep getting richer and the poor keep getting poorer. And these policies not going to stop.
So I usually never do this, but I want to share with you my personal take on all of this. Some people in the Bitcoin community believe that there will be something called hyperinflation or hyper-Bitcoinization, where this same concept of an asset being squeezed will happen, and Bitcoin would be worth $1 million by next year, or really, really quickly.
Guys, the US government's got about $10 trillion over the next 2 years to roll over, refinance. That's debt. Our country's in debt. It's a huge problem. And so what they'll do, they'll have to do is print dollars. And the only way to save yourself is own not dollars. And that's when you see things like the S&P 500 and gold and Bitcoin soar.
And as much as I love Bitcoin and I'm invested in it, I would never want that to happen. Because in order for something like Bitcoin or the stock market to shoot up in value, that would mean that something catastrophic happened to the US dollar, the economy, and it would really hurt the middle class. That's why Bitcoin is plan B. It's not the main plan. So if there is a melt up, I don't think the US will see it like all the other countries where their stock markets ballooned in value in a short period of time. Instead, if it does happen, it'll happen like it's been happening, over a very long period of time, because the US has one superpower, which is the US dollar. It is the world's reserve currency. It allows the US to export and therefore slow down asset inflation, which is a good thing, and hopefully that remains the case for a very long time. But I do think Patrick is partially right. Low interest rates, stimulus, and quantitative easing are part of the reasons why the rich have been getting richer, but it's not the entire reason. If you drew a pie chart of all the reasons why the rich have been actually getting richer over the last 50 years, stimulus would just be one of the sections of the pie chart. But there's a bunch of other equally important reasons, like globalization. Middle-class jobs were exported to other countries, while higher-income jobs, which were more tech-driven, stayed in the US. And that makes perfect sense, because the higher your income is, the more valuable your skill, the higher the barrier of entry is, which means it's harder for someone in another country to replicate that job, as opposed to, say, a factory job where it doesn't matter who makes it so long as it gets made. But another section of the pie chart would be dedicated to automation, because the less money you make, presumably the less valuable your skills are, and therefore the easier it is to automate your job. So technological advancement means that middle-class incomes were more suppressed and didn't grow as fast as the higher paying ones. And somewhere on the pie chart would have to be preferential tax policy for the wealthy. Even though the rich pay more in taxes in terms of dollar value, yes, more, they actually pay less as a percent in relation to their income. Therefore, they get to keep more of their money and they invest more, so their wealth outpaces everybody else's, while the middle class is left to fight inflation. The point I'm trying to make is this though. There's a lot of reasons why the rich got richer, and low interest rates and stimulus is just one of the reasons. And to Patrick's credit, I don't think he's saying that a melt-up or a reverse market crash will for sure happen. He's just issuing a warning that if we continue spending at the same level that we have been, if we lower interest rates, and if we're too careless, then it definitely could happen. But even if a melt-up were to happen, my research shows to stay invested in the market so you don't get left behind and miss some of the best days of the market. And look, I think it's easy for someone like me who's younger to point to a research paper and say, look, everything happens to be okay in the long term, because the truth is, we could have the opposite problem. Because of high interest rates for a long period of time, we could have a very slow meltdown and a correction of asset prices over a long period of time, which is a concern, especially for older people who are looking to retire and they're not sure on what to do. And I don't know the right answer here, because everyone will be different. That's why I try to stay balanced and talk about stocks and Bitcoin and bonds, because all of those are applicable to people at different stages of their lives. But for me, in order to protect myself, I'm going to continue to dollar cost average into the market and continue buying VTI and VOO and SCHD, and hopefully my dividend strategy will allow me to invest even in a sideways market. But if none of that ends up working out, we probably have bigger problems, and I'll see you on the Las Vegas Strip, and I hope you like card tricks. But as always, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. Would love to see you back here on Monday and Friday, sometimes Wednesday. See you soon, bye-bye.